and about reversal. What had looked like a momentum-driven surge held off. The key trigger was a rapid change in expectations for US monetary policy and for the credibility of the Federal Reserve, after President Donald Trump moved to nominate Kevin Warsh as the next Fed Reserve chair. That nomination mattered because markets treated it as a signal. It was read as a shift towards a more orthodox, more inflation-focused approach at the top of the US central bank. And that in turn pushed the US dollar higher and sent US government bond yields up. Both moves tend to put pressure on precious metals because gold and its peers don't pay interest and because they're priced globally in dollars. When those two levers move together, the effect can be sudden, especially when a rally has already pulled in a lot of fast money. We'll start with gold because it set the tone. Gold is still the reference point for the whole complex, and when it turns sharply, it often drags the rest with it, even when the underlying industrial stories for silver, platinum and palladium are different. According to Reuters, spot gold fell by about 4% in early Friday trade after reaching a record high on Thursday of around $5,594 82 cents an ounce. Reuters put gold at roughly $5,183 an ounce during the pullback. Other reporting described even larger peak-to-trough swings during the most volatile moments before prices steadied. The key point is that the move wasn't a gentle drift lower, it was a fast repricing with sharp intraday swings that told you liquidity was thinner and nerves were higher than they'd been during the climb. That's a very large move for gold in a short space of time. It's also a reminder that when the market becomes crowded and when positioning is heavily one way, the unwind can be sudden. In plain terms, if too many traders are on the same side of a trade, a change in the story can force them to exit together. That can turn a normal dip. Signs that authorities are leaning against excessive activity can change behavior quickly, even if the underlying reasons people own gold haven't changed. The immediate catalyst, though, was the Federal, and markets reacted to what they believed it implied about the future stance and credibility of US monetary policy. The Guardian reported that President Trump nominated Kevin Warsh as the next Fed chair and described an immediate market reaction that included a firmer US dollar and a drop in gold. That combination is important. A stronger dollar can make dollar-priced commodities more expensive for buyers using other currencies. At the same time, higher bond yields increase the opportunity cost of holding assets like gold, which don't pay any income stream. When those forces hit at once, they can overpower other supports, including safe haven demand, at least for a time. On the currency and rate side, Bloomberg reported the US dollar rising by about 0.3% against major peers as markets digested the Warsh news. It also reported US Treasuries falling, meaning yields rose, led by the long end of the curve. Bloomberg said the 30-year yield rose by about 5 basis points in the immediate reaction. In day-to-day terms, that's a meaningful move because it tells you the market wasn't just reacting in equities or in headlines. It was repricing the cost of money over a long horizon. For viewers who don't track the bond market closely, here's why that matters. When bond yields rise, it means investors can earn more interest by holding government debt. That can reduce the appeal of holding gold, which is often held as a store of value rather than for income. And when the long end leads, it can signal a change in how markets view long-term inflation risk, long-term borrowing costs, or confidence in policy. In this case, the move was widely framed as a credibility repricing. It's also worth noting that higher yields can tighten financial conditions more broadly, and that can encourage investors to reduce exposure to trades that have been working simply to cut risk. Now to silver, which saw a more dramatic swing. Silver often behaves like a louder version of gold. It can rise faster in a rally, and it can fall faster in a reversal. That's partly because it's smaller and can be more volatile, and partly because it sits in the intersection of investment demand and industrial use, which can make sentiment swing quickly. MarketWatch described silver briefly dropping below $100 an ounce after record highs as the so-called dollar debasement trade was hit. That phrase refers to a popular narrative in which investors buy precious metals on the view that a currency will lose purchasing power over time. When the dollar strengthens and yields rise, the narrative can lose momentum quickly, at least in the short term. And when that narrative has been a big part of the rally, the reversal can be abrupt. Across the coverage, silver's decline was described as high beta. That means it tends to move more than gold in both directions. In this episode, that pattern held. Reports range from roughly 9% to around 13% down on the day, depending on the timing and the reference price. The important thing for understanding the tape is that silver didn't just follow gold lower. It amplified the move, which is typical when traders are reducing risk quickly and when liquidity is being tested. Barron's also highlighted the role of profit-taking after very large January gains, and it noted the focus on widely watched psychological levels, including $5,000 an ounce for gold and $100 an ounce for silver. Those levels don't change the underlying value of the metal, but they can influence behavior. They're often used as reference points for stop losses, margin decisions, and headline-driven trading. When a market breaks through at a level that many people have been watching, it can change the tone in minutes because it shifts what traders think is likely to happen next, even if the fundamentals haven't changed. Platinum also fell sharply, and again the move looked more like a volatility unwind than a slow reassessment of supply and demand. Platinum can be pulled around by industrial expectations, but in a day like this it can trade as part of the broader precious metals basket, especially when investors are de-risking. The Financial Times reported platinum down by around 10% during the reversal. In the last day's trading, platinum appeared to be pulled along by the same forces hitting gold and silver: a stronger dollar, higher yields, and a rush to reduce risk across crowded positions. When that kind of selling takes hold, it can be less about the specific metal and more about the need to cut exposure wherever it's easiest to do so. There was also a China angle. The Financial Times said the Shanghai Futures Exchange took steps that included suspending a number of accounts in an effort to curb abnormal trading. Measures like that can reduce speculative activity quickly, and when speculation has been supporting prices, removing it can amplify a downturn. It can also change the intraday rhythm of the market because fewer participants are willing or able to step in and buy dips aggressively. Palladium moved lower as well, although it drew less attention than silver and platinum. Palladium markets can be thinner, and that can make moves look sharper even when the underlying driver is the same macro story. In the cited market snapshots, palladium was described as falling in sympathy with the broader complex. The declines reported ranged from roughly 4% to around 7%. There wasn't a dominant palladium-specific supply headline in the reporting. The move seemed to be mainly macro-driven, and palladium's thinner liquidity can sometimes make day-to-day swings look larger. When investors are reducing exposure across a sector, the less liquid corners can sometimes gap more, simply because there are fewer bids when selling hits. So what changed in the story over the past day? It helps to be clear about what was new and what was already in the price. Firstly, the Federal Reserve narrative shifted. The nomination of Kevin Warsh was treated as a signal that the next phase of US monetary policy could be firmer, or at least more credibility-focused. That interpretation may or may not prove durable over time, but in the last day it was enough to move markets. It also mattered because it arrived at a moment when prices were already stretched, so it didn't take much to tip sentiment. Secondly, the US dollar rebounded. That matters mechanically for metals priced in dollars. It also matters psychologically because a weaker dollar has been part of the fuel for the earlier rally. When that fuel disappears, traders who were leaning on it can reassess quickly, and that can turn a pause into a reversal. Thirdly, US yields rose, led by longer-dated bonds. That raises the opportunity